Welcome. My name is Evan Unzelman, and I am the CEO of CRT Experts. On behalf of the team here at CRT Experts, thank you for joining us today to learn about how to design charitable remainder trusts that maximize the donor's flexibility and in turn their after-tax value. For an irrevocable trust, there's a lot of flexibility a CRT can provide that's unfortunately not often fully leveraged. And we're going to talk today about what that flexibility is and how to incorporate it in the CRT's upfront design. We are recording this webinar. We'll send a link to rewatch it or parts of it to all participants as soon as that recording is available. So just a bit of a lay of the land, so to speak, for the webinar today. We'll talk about how we define maximum flexibility and why it's rarely achieved. We'll talk about the two components that we, in our experience, we believe are most often overlooked or underutilized with respect to flexibility. That is duration and deferral. For each of those components, we'll talk about how each is worked into the trust structure, how it works, where it's supported in the regs. We'll talk about different ways to implement each structure and best practices. We'll offer up some recommendations in terms of how that's implemented. We'll then continue talking about these two components, but we'll do so through the context of a case study. We'll be talking a little bit up front, but we'll be focusing on the Jones family later in the presentation. We will build a CRT for the family, and then we'll look at the results, the resulting cash flows, how it worked for the family. And if we have some time at the end, we will compare that to what we call a non-optimized or knee-jerk CRT. Before we jump in, just to give just a quick overview of our background, what makes us, well, CRT experts. For several of us here at CRT Experts, we've spent our entire professional lives working with charitable remainder trusts. Personally, in the early to mid 2000s, while still in school, and then when I was fresh out of school, I was tasked with developing a secondary market for income interest in charitable remainder trusts. That's a topic for another day, another webinar. But at a high level, the income interest in a CRT is a capital asset. And just like other capital assets, it can be bought and sold, donated to charity, used to create a new CRT with different beneficiaries. And this has always been where I've worked the most within the CRT space, what we call secondary planning, CRT secondary planning, reviewing existing CRTs and helping the income beneficiaries sell, gift, and roll over their income interest. And what that's meant and why it's relevant here is we've reviewed a lot of CRTs over the years. At last count in January, the team here had looked at over 9,000 CRTs over the last 20 years. And in doing so, we've developed pretty specialized experience in CRT design. And when you look at that many CRTs, you're going to see the good, the bad, and the ugly when it comes to the design of those CRTs, alongside the situation that the donor, the family is in with respect to the CRT, pretty deep in the life cycles. And we've turned that into a service line here at CRT Experts, helping advisors ensure that their CRTs or clients are implementing are taking advantage of the wide range of flexibility under 664, Section 664 of the Internal Revenue Code. So you see the three main services up on the screen. Importantly for advisors, we are non-competitive. We do not manage or custody assets. We do not provide tax or legal advice. Okay, so at first I want to just answer the question. So what does maximum flexibility mean? It's a pretty broad term. Generally, it means incorporating the full range of flexibility that's provided under Section 664 of the Internal Revenue Code. CRTs are irrevocable, but at the very basic level, the client should be given the ability to change the trustee, to change the charity. By client, we mean donor. To change the trustee, change the charity, change the governing law to make additional contributions in the future. Certainly, that flexibility should be available, and it usually is. Where we see the flexibility that's underutilized is these two areas that we call duration and deferral. And by duration, we mean maximizing the term, the duration over which the CRT distributes income. But really what that really means from the family, from the donor standpoint, is incorporating as many family members as possible. And in most cases, any beneficiary has to be living at the CRT's creation, but we want to incorporate all living family members that the donor wants to include when the CRT is created. And second, by deferral, we mean providing for the ability to regulate the distributions from the CRT. And some generations are going to want to defer the income, some will want it, and so we want to provide for that flexibility. So we'll drill on those two topics for the rest of the webinar, but just here at the outset, just want to address why the flexibility is rarely implemented in the first place. This whole presentation really raises that question. And in our experience, there's really two reasons for that. Above all, I think just generally, we look at CRT design from the point of view of the property owner, the wealth producer first. And while that's particularly for tax, legal, and financial advisors who are on this webinar, that would sound like a given. But the reality is many CRTs in existence today were promoted by charities. And when we think about the charity's motivations with respect to the CRT, they're really the inverse of the donors. While the donor probably wants as much income as possible and for that CRT to distribute for income for as long as possible, the charity wants the opposite. They want as much money as possible as soon as possible. So it's natural to assume, and what we've seen is if the charity is involved in the creation of the CRT, in many cases, that CRT is not going to be optimized for the taxpayer, for the donor. In other cases, the professionals involved when creating this CRT, while in most cases certainly well-intentioned, just didn't have the necessary experience, and we're simply unaware of the full range of flexibility available under Section 664. So there's this other, we call it the knee-jerk CRT. It's sort of this natural tendency, right? I mean, our brains are hardwired to prefer information that aligns with what we already know. And so often when client has appreciated property, they don't want to pay the tax, they want to diversify it. They're not just ready to unload that asset to charity, set up a CRT for the husband and wife, and then it'll pay out to the charity, alma mater, whatever. And there's really not, we need to go beyond that and think, well, what if we want to include children, and what if we want to include some of the ability to defer income and things like that? So it's what we call the knee-jerk, sort of the status quo CRT. But whatever the reason, the end result is the same, and that is flexibility that the donor in many cases would have chosen to include had they been made aware of the opportunity to do so was not utilized. And that's what it comes down to. Put the full menu of options in front of the client so they can pick and choose the features that they want included or not included in their CRT. If the client chooses not to implement all the flexibility, that's fine. The point is they've been made aware of it. They made the choice. As the late Steve Jobs said, how does someone know what they want if they've never even seen it? And that's really the point here, just making sure clients are aware of those of the menu of options. So let's talk first about duration. So in general, the goal with respect to duration, should be to include as many living family members as possible and to extend the expected duration of the CRT as long as possible. If given the choice, most donors will give up some upfront deduction. Now, if we're maximizing the duration, we're minimizing the charitable tax deduction the donor receives when they establish the CRT. That deduction is based on what's expected to go to charity. And so if we're maximizing the duration for the income beneficiaries, that's going to minimize that upfront charitable deduction. But in our experience, most clients would be happy to give that up in exchange for including their heirs as income beneficiaries of the CRT. Yet they just aren't made aware of the ability to do so. Again, that knee-jerk CRT, husband and wife, and then the charity. I mean, I can't tell you how many times we've had an older couple with the CRT ask us, can I add my kids to my CRT as income beneficiaries? We can't do that, of course, but we were seeing or hearing this request so frequently in the late 2000s that's what spurred us to develop this rollover technique, where we can't just put your kids on the CRT, but what we know that your interest in your CRT, that's a capital asset. We know that that can be monetized on a secondary market. So let's create a new CRT and then use your interest in your existing CRT to fund and monetize that new CRT. But in many of those cases, there wouldn't be a need for the rollover if the client had added their heirs in the first place. Now, there's always in it this inherent combination of a CRT. You have an irrevocable trust on one hand and a very long duration. We don't have a crystal ball, obviously. So there are just, in many cases, when we're brought in deeper in the life cycle of a CRT, where there's a misalignment between the client's situation today and the irrevocable terms of the trust they created 20, 30 years ago, that was unforeseen. There's no way anyone could have predicted it. But in other cases, had that client been made aware of some of this flexibility, they would have included it. So let's talk about how we maximize the duration. Ultimately, what we're up against when it comes to this, that maximizing the duration, is the 10% remainder test. So that is when I set up a CRT, the value that the IRS projects will go to charity must be equal to at least 10% of the value on a present value basis of the value of the property that I donate to the CRT. So the two key factors here are the ages of the income beneficiaries and the payout rate of the trust. So to maximize duration and the number of income beneficiaries, we're usually going to set the CRT's payout rate at 5%, which is the minimum required rate. Secondly, we're going to use what we call the life plus term or lives plus term structure. And this is, it's always surprising, even as we're talking with really sophisticated advisors, the confusion around how can a unit trust period be structured. In many cases, the assumption is, so if we look at, you can see up on the screen, the section of 664 where this is stipulated, says a CRT term may not extend beyond either the life or lives of a named individual or individuals, or a term of no more than 20 years. This does not mean there are only two choices, life or term. So we can structure a CRT so that it pays the life or lives of the initial beneficiaries, followed by payments to successor beneficiaries for the shorter of a term of years not to exceed 20 years and the life of those successor term beneficiaries. So as long as the trust is worded properly, we can move to this joint lives plus term structure. Yes, the trust cannot last beyond the lives in being at the date the CRT is created, but we are not running afoul that requirement if we're structuring this appropriately. So not only are as I mentioned, so we've even very sophisticated advisors are unaware of just the ability to go life plus term or really how it works. Literally the people who write the software. So anytime that we're looking at that 10% test, or we're calculating a charitable deduction for a client who's establishing a CRT, or if they gift their interest to charity, we're calculating the value of the income interest for the deduction. We need software. So if we're using one of several different versions of software, and we're using the current 7520 section 7520 rate from the IRS to value the interest. Now, there are many versions of software out, well, not many. There are several versions of software that we've had in the past where they did not even include this CRT structure, the life plus term. We have two versions of software we use at CRT Experts. One of a screen grab from one of them up here on the screen. This one does include life plus term, but it's limiting the number of lives to 2. And that didn't make sense to us. The code does not explicitly limit it to 2 lives. We know we have to pass the 10% test, but if we can pass that with 4 lives, there's no reason we couldn't move to more than 2 lives. So that's the reason we have a second version of software, which will calculate, we'll run the numbers for more than 2 lives plus a term, and we'll see that later in the presentation. So the Jones family. So the second point and final point on duration here is in some cases we're going to have to use multiple CRTs to include all the family members and to maximize the duration. So if we're looking at the Jones family, we have Stan and Peggy, and then they have 3 children, Lisa, Larry, and John. All are married with children. And so if we're creating a CRT for Stan and Peggy, the goal is usually include as many of these family members as possible. To do that, we can't use one CRT. What we're going to do in this scenario is we're going to have 3 CRTs, and each CRT will be structured for a different family unit. Each child, their spouse, and their kids, Stan and Peggy's grandchildren. So the way that Stan and Peggy will be the initial lifetime income beneficiary of each of these CRTs. Then each child and their spouse will be the successor lifetime income beneficiaries. And then for the grandchildren, that's where we're going to move to the term. And we're limited to 20 years on that term. But as we'll see later when we look at the specific terms, we're not quite able to get to 20 on any of these. So on Lisa's, who's the oldest, the daughter, who's the oldest child, we're almost getting there. And then we'll see with Larry and John, we're I think at 13, 14, 15, somewhere in there in terms of that successor term. What the software allows us to do, Easy Charitable, the software allows us to do is get very specific with maximizing the term for that 3rd generation. I mean, down to the day. It's as we'll see. So we know we have to pass that 10% test, but when we're establishing the trust, we want to take that successor term as close as we can, or as far out as we can, without failing that test. And we'll see how the numbers look later in the presentation. Okay, on to deferral. In many cases, the donor, so Stan and Peggy in our example, the donor is looking to, of course, number one, sell and diversify appreciated property without paying the tax. That's the driver behind all CRTs. The creation of the CRT is to defer capital gains tax on the sale of appreciated property. That's what's driving the decision to create a CRT. But in many cases, the donor, Stan and Peggy, are not interested necessarily in, after that, maximizing their own income. They're looking at their children, their grandchildren, their heirs. And in some cases, the knee jerk might be, okay, we'll just create the CRT and then put your kids on as the initial income beneficiaries. We don't want to do that. And the reason is because we can structure a CRT so that if Stan and Peggy don't want any income, they can defer the income, allow their investment advisor to manage those assets, to grow all those assets tax-free. And in the end, give their children and their grandchildren a much larger income stream because you've supercharged it effectively up front. You've put that trust into deferral and allowed for this upfront deferral period where everything's just growing tax-free before it begins to distribute income to their heirs. So to do that, we're gonna use a type of CRT called a net income with makeup, charitable remainder unit trust. It's often called a NIMCRUT. So this, many of you are probably, I'm sure, aware of NIMCRUTs. It's the specific structure around that NIMCRUT that's going to give us the true ability for pure deferral. So, but first, let's talk about the NIMCRUT itself briefly, and then we'll talk about how we control for that trust accounting income. So a NIMCRUT, net income with makeup CRUT, will distribute the lesser of the stated payout rate to 5% in our example, and trust accounting income. So there's this income exception with the NIMCRUT where it's never required to pay the beneficiaries or beneficiary more than its income. So if it doesn't have income, if we can control that trust accounting income, nothing has to be distributed. And we have this makeup provision that enables us to pay any unpaid or deferred amounts in future years. So that combination, the income exception and makeup provision in a NIMCRUT, are what we're going to use to control the trust and accounting income, and thus the distributions to the income beneficiaries. So the key, we'll look at the deferral technique next, but the key sort of this is all centered around trust accounting income. Trust accounting income or trust income, it's a cash concept. And what that means is that the trust will not have income until it has a cash receipt. So we're going to look at these three techniques, the three most popular techniques for providing this deferral ability to defer income, but each of them is working the same way. It's using what's often called a container to house the NIMCRUT's investments, and then that container, whether it's an annuity, a partnership, or an LLC, will distribute cash to the NIMCRUT when income is desired, and that receipt of cash is what's triggering the trust accounting income. So with a plain vanilla CRT, so let's first think about a NIMCRUT that doesn't have any structure for deferral. So that would mean the NIMCRUT would just invest in a mixed portfolio of stocks, bonds, and funds, and then any interest, dividends, or realized gain would have to be distributed as it's triggered. So we don't want that. So what we need is again, it's often called a container to hold the investments of the NIMCRUT. So that way, until we distribute cash from that container to the NIMCRUT, we don't have trust accounting income that has to be distributed. So the interest, dividends, or realized gain that would need to be distributed if the NIMCRUT owned the assets directly, those are still incurred, but the trust accounting income isn't triggered until we have these cash distributions. So that's going to be the case. That overall structure is going to be the case with these three techniques we'll talk about. But there's a couple of disadvantages to the first two techniques, and that's what leads us to the single member LLC being, in our opinion, the optimal structure here, and we'll see why. So first is using a variable annuity. So the NIMCRUT can purchase a variable annuity, and that annuity will then in turn invest in a variety of funds and assets. And until there's a distribution from the annuity to the CRT, there's no trust accounting income. So that annuity can grow over time, and all of that deferred gain, all that growth, to the extent that the makeup account is if the trust is growing at 7% and the payout rate is 5%, you're going to have more growth there than what can be distributed, because you can only distribute up to the accumulated efficiency, that makeup. But the general idea is invest the CRT in a variable annuity. That annuity grows over time as cash is desired or distributions are desired. The annuity can make cash distributions to the NIMCRUT. That works just fine. The drawback, of course, of an annuity is that all the income flowing from annuity is taxable as ordinary income. So you can build up a lot of growth and deferred gain there that you can take, the beneficiaries can take, but it's all going to be ordinary income. So to get around that taxation drawback, the ordinary income drawback, in many cases, the NIMCRUT will hold its assets in a partnership. So same concept, the assets are in a partnership. The partnership can be invested, interest, dividends, realized gain, that's all, it's flow through, but it's a flow through to the NIMCRUT's tax exempt environment. So there's no tax owed. That it is tracked on the CRT's tax return, the 5227 in the accounting tiers, but of course the key, we're not triggering trust accounting income. So the NIMCRUT works well. It gets us around the ordinary income drawback with the annuity. The disadvantage with the partnership is we need two partners, and so we need to file a separate tax return. So now we've got to file a 1065 and issue the K1 to the CRT, thus complicating the administration of the NIMCRUT. So to get around that limitation, we're going to use a single member LLC. So most states now permit the formation of a single member LLC, including Delaware, which is where we will typically, the trust will typically be under Delaware law. We'll talk about why. So it's the same concept as a partnership, except now, because of the LLC is a disregarded entity, we don't have that extra tax return complicating the administration of the NIMCRUT. So it's very similar overall in the result. We can get the capital gain, unlike the annuity, but we're able to simplify the administration by using the single member LLC. So to illustrate this, before we jump into just some recommendations, and then we'll look at the Jones family and build them a CRT. Just to illustrate this, so of course the first step here is we have appreciated property that's going into the CRT. It's going into the structure. So in our case, we'll look at Stan and Peggy Jones. They have appreciated real estate. It could be appreciated stock, close held stock, public stock, any capital asset that's appreciated. Is usually, as long as the client doesn't need the money from selling that personally, is a good candidate for a CRT. So that appreciated property is going into the into the NIMCRUT LLC structure. We will usually recommend, well, almost always would recommend a single member LLC, but not having the donor as the manager of the LLC. So we recommend a single member manager managed LLC and not having the donor as the manager of the LLC. The reason why is pretty simple to see. So what's triggering the trust accounting income? The cash distributions from the LLC. So these are often called spigot trusts or faucet. So the concept is that manager, by making cash distributions or not to the NIMCRUT, is able to turn that income stream on and off. So we would not recommend. Now we see this frequently, and I'm not aware of any issues or it creating any problems. It's easy to see the potential problem, right? We have someone controlling their own income. So we would always recommend not putting a disqualified person on that. It's usually, in practice, it's usually the donor's CPA, financial advisor, or attorney. But we would not recommend putting the donor on as the manager of that LLC. So as those distributions are made to the NIMCRUT, the trustee, which can be the donor, there's no problem there. The trustee will allocate that income or allocate that those cash receipts to income, trust accounting income, and then it's flowed out to the income beneficiaries. So that's what we've talked about, but just an illustration to demonstrate how this works from a visual standpoint. So just to run through some best practices here in our view, our recommendations, we recommend Delaware law. With the revised Uniform Principal Income Act, this is always, this structure with the NIMCRUT is possible in states that defer to that act. But in Delaware, there's some, and we'll see them here in a couple slides. There's some advantages just from the flexibility standpoint. There's a carve out for NIMCRUTs. So we will, but again, in interest of maximizing flexibility for the client, we want to give them or the trustee the ability to change the state law. No reason not to give them that power, but we initially would always recommend the controlling law being Delaware. Now, one thing that's very important is, we always, and this is for the drafter, for all of our attorneys out there, we always want to place the desired accounting rules in the text of the trust instrument. So we're not going to rely on the principal and income acts. We want to explicitly state in the trust instrument, in this case, how income is defined. And so there's a few key points. If we're using Delaware law, we want to incorporate by reference the Delaware Principal and Income Act. We want to allocate to trust principal all pre-contribution gains. So the appreciated properties going into the CRT. In the Jones example, you've got a $12 million real estate position with basis of $2 million. That $10 million pre-contribution gain should not be allocated to income. That is principal. Any post-contribution gain, though, any gain beyond that 12, the value of the property that's donated, should be allocated to income. And then, and that's the example up here on the screen. We want to explicitly write into the trust instrument regarding distributions received on account of a trust investment in an entity. We want those to be allocated to income as well. So if we look at the Delaware Principal and Income Act, and this is what we're incorporating by reference, you can see we've underlined a couple of these, the key parts here. You can see it says, if the trust instrument adopts the provision of this section by reference, so we've done that where we're defining income, an increase in the value of the following investments owned by a CRT described in section 664D3, that is a NIMCRUT specifically, we have the net income limitation, is distributable as income. And one of those, you see the 1, 2, 3, 4, 5, 6, number 5, we can see that's an interest in a partnership or an LLC. And then down in B, we see that the increase in value of an investment described in A is available for distribution only when the trustee receives cash on account of the investment. So we can't distribute property. We can't distribute in kind to the NIMCRUT. That's principal. We need cash distributions from, in our case, an LLC to the CRT to trigger that trust accounting income. Finally, just give that trustee the power to allocate between principal and income. This is we see this in most NIMCRUT trust instruments, regardless of the governing law. We always want to see that as well. Okay, so let's look here at the Jones family. So Stan, we've seen kind of the family layout. We'll see the ages here in a minute, but Stan is, he's a successful real estate developer, and he has $12 million of appreciated real estate. His goal, and his wife, Peggy, they want to diversify that position. They don't want to pay any tax. Like many, this is a very typical client profile. That first generation is not looking for a lot of income or any themselves. So they want to minimize their own taxable income while maximizing the future income that's available to their children and grandchildren. So we saw the family earlier. We can see the ages here. And so what we're going to, again, we're going to use 3 CRTs. One for each family unit. We've got that 12 million. It's usually just going to be evenly split across those 3. So we've got 3 $4 million CRTs, one for each family unit. Now what we need is that software. We know it's going to go 4 lives on each of these, to Stan and Peggy, and then for each child and their spouse for lifetimes. And then we will go to the grandchildren for the shorter of their lives, or a term with a maximum of 20 years. So what we need to figure out is how to maximize duration. We want that term out as far as we can. So to do that, we use Easy Charitables. If any of you know Lee Hoffman, this is his software. So this is going to allow us, unlike we saw the software earlier that doesn't allow us to go more than 2 lives plus the term. Well, we want to go 4 lives here plus the term in each one of these scenarios, and that's what this is going to enable us to do. So we can see, so over to the right, you can see this is the output over here from the software. And really what we're looking at here is what's that maximum term. So we see here, we're going for life, for life, for life, for life. So we've got 4 lives, Stan, Peggy, their daughter, Lisa, and her husband. And then we're going to go to the 2 grandchildren. And we want to run that term out as far as we can. We can't go beyond 20 years. In this case, what's great about this software, you can get it to the day. And so we're out 19 years, 11 months, and 14 days. So we're almost getting up to that maximum term for Lisa. Of course, as the kids get a little bit older or younger, sorry, it's that 10% test. You can see down here, see we're at 10.01. So we're right at that line of meeting that 10% test. And we can see to do that for Larry's family, we're at 16 years, 4 months, 14 days. And then for John, who's the youngest, for his family, for his two daughters, that successor term, we're at 13 years, 5 months, 14 days. So that's how we're maximizing the duration. So before we look at the cash flows, let's just think about this from, okay, so what have we done here? For Stan and Peggy, we have diversified that real estate position with 0 tax. They've picked up a $1.2 million charitable tax deduction, 10% of the $12 million. They've created income streams for their children and grandchildren. They always do have that safety net. If they won't, in these situations, the chances that Stan and Peggy will ever need income from the trust is almost 0, but it's there. When the trust is put into deferral, they can always tap that makeup account should they desire that income. But more importantly, they are creating sizable income streams for their children. And then finally, from a charitable standpoint, they're leaving their grandchildren and as we'll see, their great-grandchildren, if their grandchildren have children, a meaningful amount of charitable assets. So in most cases, what we see is the ultimate charitable beneficiary is a donor advised fund. So in most cases, we would see one. So we have those 3 CRTs. Each family would have a donor advised fund where because it's a term for those grandkids, in most cases, if you look at how old those grandchildren are expected to be when that term is up, they still have, they're going to live well beyond that. So we're giving them now the ability, that CRT's got to go to charity now, the assets got to go to charity, but it's going to go to a donor advised fund where they and their children can give the money away, which would be the great grandchildren for Stan and Peggy. So when we structure for maximum duration, but really the flexibility to defer income, it creates many potential scenarios because we've got the ability to regulate the income stream. So let's look at one. And this is what Stan and Peggy think is most likely. They'll defer all income. Lisa and her spouse, Larry and his spouse, will take the income. John is in a different financial situation, is likely to defer the income, and then the grandchildren will take all the income. So let's look at this from a cash flow standpoint. So here you can see we have each CRT. We have Lisa's, Larry's in the middle, John's there on the right. And there's $4 million going into each CRT. And in during the green phase, that's when Stan and Peggy are the lifetime income beneficiaries. They have a 12-year joint life expectancy. The trust is in deferral. So that allows our investment advisor, if this is growing at 5% over 12 years, to get that up to north of 7 million. At that point, when Stan and Peggy, the last of Stan and Peggy pass, that's when the children and their spouses will step in as income beneficiaries for their lifetimes. And we see Lisa and her husband taking the income, Larry and his wife taking the income, and then John and his wife continuing to defer the income. So that third trust is going to be in deferral over those first 2 generations. You can see and we'll look at the individual family outcomes here momentarily, but you can see the outcome there at the top. You can see down here, this is Lisa. Her life expectancy is a little bit shorter than Larry's, a little bit shorter than John's, but they're all ending at the same time. For John, we didn't have as long as a term possible in maximizing in passing the 10% test because he and his wife have a longer joint life expectancy over here than Lisa does. So let's look at what we've done here. So for Lisa's family, we have $4 million going in. Lisa and her husband took out about $7.9 million. Their children, Stan and Peggy's grandchildren, about $7.2 million. At the end of that term, the remaining assets, $7.2 million, go into a donor advised fund. At that point, Skylar and Kyle, the grandchildren, probably going to be at the age where they would have children of their own. So the entire family, the grandchildren and great-grandchildren, can be the charitable advisors with respect to that DAF and give those charitable assets away. Similar results here for Larry. Larry and his wife had a little bit longer life expectancy than Lisa, so we see a little bit more income for them and a little bit less income for the grandchildren. And again, we've got about $7.2 million going into that family donor advised fund. And then for John, remember, he and his wife elected to defer the income. So that their NIMCRUT was in deferral for 2 generations. And that just creates a whole lot more income, of course, because you have a much higher asset base for their children, Stan and Peggy's grandchildren, to receive income from. Now, one thing to note is in these scenarios, we never tap the makeup account. So in the makeup account is growing over time. All that deferred gain is growing. When we started taking income, we assumed that they took it at the 5% payout rate. But with the NIMCRUT, with the makeup account, there's a much larger available pot of potential income each income beneficiary can take. Of course, to the extent that they take that, it would reduce the trust value, and there would be less income in the future. But lots of flexibility there. And we're just modeling what we think would be sort of that base scenario. So in total, we can see we got that $12 million of appreciated property, and we've created almost $50 million of income for the kids and grandkids, and about $43 million of charitable assets that the grandkids and great-grandkids will give away. So pretty powerful if the client's able to withstand that deferral period. In many cases, indeed, they don't want the taxable income. It's pretty powerful what the CRT can do if it's structured properly. If we're maximizing the number of beneficiaries, family members that are receiving income, and how long that CRT is paying out, and we're giving any income beneficiary the flexibility and to defer income, and by controlling the timing of the trust accounting income. So we're just about out of time, but so we talked about the knee-jerk CRT, right? So what would happen in a lot of cases, what would happen here is we'd say, or we've seen, okay, well, we've got this family, remember the chart. Okay, well, let's set up a CRT then for Stan, Peggy, and the 3 children. In that case, let's assume they put that trust into deferral, Stan and Peggy do. But instead of moving to that life plus term structure, we're limited only to so 5 lives, which would pass. We can see we took the distribution rate up to the maximum, which would be about 6.8% given everyone's ages. And let's see how that would compare. So there you can see there's about $31 million of income that's distributed to the children. Stan and Peggy, they're still deferring the capital gain. They diversify the asset. They don't have any taxable income. But you can see that there's no income to the children when we compare this to what we modeled or the grandchildren. And okay, well, there's 31 million to the three children versus 17 in our modeled scenario. But remember, John and his wife deferred income. So if we, and that's, I mean, it's just getting to the beauty of the flexibility here is, let's say that John and his wife decided to take the income. That would lower the income that goes to the grandchildren, of course, because their children would receive less, but it makes it more apples to apples. So if we introduce that, if we look at that flexibility, we can get back to just about the same amount of income to the children, but then we've got $18 million of income to the grandchildren versus zero. So just an idea here of when we talk about knee-jerk status quo, it's not it's not meant to be a negative, but it's we really want to think about, if the trust is irrevocable, but the service Treasury has given us a fair amount of flexibility under 664 that we can use to truly maximize the ultimate value to the family. And that's what a properly structured CRT can do. So hopefully this has been helpful for everyone. We're keeping it right. Well, just a couple minutes past, so hopefully we try to get everyone out of here on time. Obviously, if you have any questions about anything we've gone over here today, my contact information is up on the screen. Just give us a call, shoot me an email. Be happy to answer any questions you have. And we will, as I mentioned at the outset, we will make sure to send around a link to watch or rewatch the webinar. And you can go to any parts that might have been of particular interest, but please do not hesitate to reach out. Thank you again for joining us. I hope it's been informative, and please have a great day.